So what does this new IMF forecast mean for Joe Hockey's plans?
Well, it means that the G20 growth target agreed to in February has suddenly become much more difficult. The IMF has downgraded growth by 0.4% for 2014, which means suddenly the G20 and Joe Hockey are going to have to make up for that lost ground.
So why are the IMF cutting their forecast?
A lot of it has to do with base effects coming from the US. The US economy contracted in the first quarter, and that's basically shifted the annual growth rate down for the year.
And so you looked at the US last night in terms of the economy. There was inflation came through and also home sales. What did you find?
It's a bit of a mixed bag for the US. So their labour market is performing quite strongly. Job creation is quite high, the highest level in around 8 years. But the housing market has been quite mixed. Housing sales, for example, have been quite slow. And also consumer spending has been a little bit more subdued than you might expect after a poor first quarter.
So we're looking at the US then not being the driver of growth we thought it was going to be?
I think the outlook for the US is still quite strong. I expect that their strong labour figures will feed into stronger growth across the broader economy over the rest of the year and into next year. But at this stage it still looks like China is going to be the primary driver of growth over the next couple of years.
But the IMF was saying that they've downgraded their forecast too for the Chinese economy. Why is that?
Well, the Chinese economy is moderating somewhat. They're returning to more, I guess, normal levels of growth. But there is still some risk that the Chinese economy could slow a little bit quicker than the IMF expects. It's probably one of the big downside risks of the global forecast at the moment.
And the other big risk, of course, is geopolitical tensions.
Exactly. I mean, that's a big unknown at this point. But if it turns out poorly, then that would certainly affect the oil price, which would affect factors of production across the world.
Yep. So one of the things people are talking about is putting sanctions on the oil and gas sector in Russia. Given that Russia supplies something like 40% of Europe's energy needs, if that happened, would that mean that Europe would get another blow to their economy just at a time when they couldn't afford it?
It certainly seems that way. I mean, countries such as the US have become a little bit more self-sufficient, but Europe still relies on the Middle East and Russia to supply their oil. So if that comes through, then it's certainly going to hurt their growth prospects, which are still pretty terrible.
Callum Pickering, thanks very much.
Thank you.